Hi, everybody, and welcome back to the Middle Class Investor. This is Seth Martin, your host. Thank you again for joining me this week. Well, Friday we had a pretty exciting down day in the market, if you want to call it that. The bears got control of things and decided to sell off pretty dramatic fashion. We had 23. Almost a 24-point loss in the S&P 500. The Nasdaq was a particularly brutal sell-off. It sold off 110 points. It's a pretty big move on the Nasdaq. So, what to make of this? Maybe not a whole lot yet. We'll continue to watch and see how things go. What I've got up here on the chart, which I think is an important thing to continue to watch, and what I think if you've got a 401k or an IRA, this is the type of thing you need to really watch out for. Now, each one of these bars is a month, so what I've got up here is 10 years worth of data. And you can see this is a month, this is a month, this is a month. And we've been talking about this rising wedge. Of course, it's been rising now since the bottom in '09. And it continues to rise and it continues to tighten up. Coil like a spring is what we talked about before. And so what we want to watch for is the price breaking out of this pattern and likely retesting. Let's go to a weekly chart, and you can just see it's just 5 years worth of data. We'll zoom in a little bit. It doesn't even look like much has happened really when you step back and look at a week, which is that's pretty typical. The further you look back, the more the fluctuations are kind of nulled out of the picture, and that's fine. That's what you as a 401k investor or an IRA investor, you're not really concerned about the noise or the daily range or high frequency trading. Boy, that's been in the news a lot. High frequency trading has almost no impact, regardless of what the media is saying right now, on traders or investors that basically invest for long periods of time. Now, high frequency traders could impact a large investor like a Warren Buffett who's trying to get into a position, he's trying to buy 1 million shares, and he has to buy it in 500 share blocks and sneak into it over a 2 or 3 week period. Yeah, Warren Buffett's gonna, each time he buys, somebody's gonna see that volume, and they're gonna try to get in front of him a little bit. But by and large, this is in my opinion, is a non-issue in the marketplace for most of us. Technology is something that people, to the extent they feel like they can get an edge in the market, they're going to use technology. So, individual traders have a lot of technology at their disposal these days. The platform that I'm sitting on right now is owned by TD Ameritrade. It's called Thinkorswim. It's won all kinds of awards for traders, polls and things like that, where they've polled traders and asked them what the best software to use, and it's got a lot of technology built into it. So let's just zoom in here for a second. And let's look at what we got this week. So you can see kind of what happened is the market opened down here at the bottom of this square. Well, actually, I'm sorry, it opened here at the top of this square, this little bitty square at the end of this stick, and the bulls pushed it all the way up here, actually to a new high. And we'll go to a daily chart here in a minute, and there was a new closing high on the S&P 500. But then the bears took over and said, that's too high, and they pushed it all the way back down to actually almost the low of the week. This is a pretty bearish, just without looking at anything else, this is a pretty bearish scenario, and so we're going to keep a close eye on it. What we're going to look for, though, is we want to see these weeks start to develop a trend. So just like these weeks were developing uptrends, you had a white candle followed by another white candle followed by a white candle, and then you had a slight little pullback, and then another white candle, so on and so forth. We want to see if this is going to be more than a pullback, then we want to see a couple of weeks here of this trailing off. Now we still got support down here in our blue box, and so we just want to watch this area closely. This is we're getting close to this this narrowing of this rising wedge, and this is just an area that we need to be vigilant, I guess is the right word, and we'll continue to be vigilant as the days and weeks progress. Now, one of the things I wanted to point out that might not be that obvious, the market, it trends up, it trends down, and sometimes it just has a sideways trend. And so you could really kind of look at this area right here as just a sideways trend. Now, when the market trends sideways, it eventually, resolves itself one way or the other. It looked like it tried to resolve itself to the upside, and the bears just weren't having it this week. So it could be that we get a little bit more selling early in the week next week, and then the bulls maybe take another run at it. And I would say that if they can break out of this box, then we probably will test this upper line of this rising wedge channel. And so we'll just look for that to happen. Now, let me zoom back out, and let's go to a daily chart. We'll look at a 9-month daily, and you can see this. It's easy to see here the. Oops, sorry about that. It's easy to see here the box that we were pointing out a minute ago. If I could draw it correctly. Alright, you can see here, I drew it in the wrong place. You can see right through here we've got this sideways pattern. So we might get a little bit more selling, maybe down to the bottom of this box, maybe not even that far, and then it may resume its direction here to the top of this channel. We'll just watch it close, see what happens. Now, one of the things that I wanted to point out this week is some of you, if you're traders, investors out there, you might be using some indicators. And we've had some indicators up here before. Haven't spoken much about them. But indicators, first of all, are lagging. So they're built on the open, high, low, close of the price action. So they don't really tell anything about what's going to happen. So, try not to be that person that sees something that happens on an indicator and says, oh, this is going to happen or that's going to happen. It doesn't necessarily mean it's so. It may happen a high percentage of the time, and if you want to build a system based on that, that's fine. But just remember that they're lagging, so they don't really tell anything about the future. They tell kind of what's happening, what's happened, and what's maybe likely to happen. I guess you could look at it that way. So one of the things I've done here is I put a line. You can see this little blue line down here, and I've kind of connected the peaks of this little histogram here with the peak of this histogram here. And what you'll notice is as the market was making its way higher, this is called the MACD. It stands for Moving Average Convergence Divergence histogram, and basically what it's kind of an internal momentum indicator, And so you can see that as the price was moving up, momentum was dropping off. And this is what we refer to as a divergence in the market. So we had an increase in price over some period of time, and then we had momentum diverging negatively. So underneath the market, people were selling more than they were buying, and yet the price was going higher. So, and that happens from time to time, but normally when you look at the MACD will move in the same direction as the market. Now, it's an oscillator, so it moves up and down all the time. And again, sometimes you see these things and they don't really mean anything. It's just something to be aware of. Now, we've still got our box here on the screen. We've talked about the box here and the significance of where it's located and what we might look to happen. But the bottom line is the support is still intact. We've done nothing but trade sideways above it, which is fine. The more time that is spent here trading sideways above our support, the stronger this support becomes. Now, the only reason we might expect something to happen, even if it's just a 10 or 15% correction, we might expect something to happen downward, is because these wedges, these rising wedges, are pretty high probability patterns that we look for. The thing about this one is it's so big. I personally am not used to seeing them this large, so I'm looking at one that might be weeks to months long. So to me, who knows what this thing is gonna bring? But we want to keep a close eye on it. We don't want to ignore it. We want to have an option if things start to do something we don't expect it to do. Other than that, I don't really know what to say about this week in trading or investing. I have noticed that the talk about the economy and it seemed to have slightly turned negative here. It was very bullish even through this downturn here. There was a lot of talk about about how the economy was getting stronger, albeit slowly, and this was going to be prices were going to move much, much higher from here. A lot of that talk has seemed to slow down a little bit, which is unusual, because usually, they'll talk that thing up right until the bitter end. I mean, it's what I've noticed. But this week, actually the last couple of weeks, they've really been talking it more modestly. So we'll wait to see what happens there. Let's take a quick look at bonds. This is let me see if I can get the TNX, because that's what we looked at last time. This is the Treasury yields. So we had talked about, I'm not sure if you remember or not, but we talked about how this looked like it was coming down, but it might go up a little bit first and then come down. And so I would say that that's likely a good estimation at this point, especially if the market sells off here. Now it might go up and make another little high before it comes down, but I would say that if the market sells off, you could expect interest rates to take one more run lower down into this region here, this 2.4%. So if you are looking at buying a house, you might try to time that with a really good interest rate. But I think the key, if you're looking at the TV or something and you're trying to, keep an eye on this 10-year interest rate, because this is the whole impetus for the Fed getting involved in the bond market, was to keep these rates low. Now, personally, I'm not sure the Fed. I mean, I think they think they have an impact on the market, but this market is very, 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 very large. I mean, it's trillions of dollars large, and I'm not sure the Fed has done anything except give some investors a way to get out of the 10-year Treasury. In other words, if they're buying, if the Fed is buying, then if I own a bunch of 10-year Treasuries, guess who I can sell them to? The government. And then, I took my profits and lo and behold, the taxpayers bail me out again. So that's probably, in retrospect, that's probably what we're going to find that the Fed actually did. The Fed probably didn't do anything to keep interest rates low. I think this one more run to the bottom down here into support is probably going to be driven by just fear in the market. You're going to see, because a lot of people have piled into the market here at the very end of this period, this last 6 months or so, and they're going to need a place to run to. And the 10-year Treasury is typically considered one of the safest places to run to if you need a liquid market to stash a bunch of money in. So watch this carefully, the 10-year Treasury. If the market starts to sell off, I think you'll see the 10-year Treasury fall into this area. And then ultimately, I think we talked about this before, but ultimately the 10-year Treasury is at its low and is going to be, it's already started to make its move up. I mean, this was the bottom down here, the 10-year Treasury. And it's going to continue to march higher from here. So, but keep an eye on it. It's a very important financial instrument. It drives quite a bit of activity across all markets. So that's it for this week. Thank you again for attending. We're going to keep a close eye on some of these patterns as they emerge, and hopefully keep each and every one of you safe in the market. As we know, as we go back real quick and just look at a little bit of history. The saying is in the market, the market takes the stairs up and the elevator down. So what we want to do is, it's fine that you can put your money in here and go to sleep and rest easily, but when we start to identify the elevator move, we want to make sure that we are safely on the sidelines or safely in something that is not going to participate in this. In this case, the elevator is not your friend. It is if you have a bunch of stairs to climb, but not in the market. So until next week, probably Wednesday again, thank you for visiting the Middle Class Investor, and good luck to each one of you.